Let's swerve back to the US election. As I said, inescapable at the moment in terms of perhaps its impact, not just in the States, but it does have clearly a global impact also for investors. So how is it likely to affect portfolios? To explore some of the historical trends that we've seen, let's catch up with Robert Baharian. He's the founder and chief executive of Baharian Wealth Management. Robert, good to have you back on ausbiz. So,
Andrew, good morning.
Does it really matter at the end of the day whether it is a Republican or a Democrat in the White House?
Excellent question. I think the question that's may not be asked enough. What we've done is I just want to use a little bit of data to help us understand what the market is telling us ahead of US presidential elections as they go to the ballots tomorrow our time. If we bring up the first slide, which looks at S&P 500s ahead of US presidential elections, and what we've done here is we've said 3 months leading out to a US presidential election, what is the stock market doing? And what we've found is that whenever the stock market is present positive 3 months out from the US election, we see an incumbent victory. And when we see the stock market negative for that same period of time, we see an incumbent loss. Now, what the data is telling us thus far is, you can see by that red dotted line, is well and truly up in the positive. It's taken a little bit of a downturn with the October finish down about 1% for the month. But that's telling us that the incumbent is likely to win. That's what the market and what the data is telling us. What's really interesting, though, is that during the last 35, 40 years, we've never actually seen a president not rerun for election. Now, this is very unusual, and which tells me that it's hard to simply look at this data and make any firm conclusions. We may very well see a Trump victory, and the odds are telling us, now not polling odds, I know Chris was talking about polling before, but this is real betting odds with a 60% odds on Trump and a 40% odds on Harris. So the polls are telling us one thing, the stock market's telling us something else, although it is very unusual to not have the incumbent rerun for election.
Yeah, that's a good point to make. So perhaps we're diverting from history just a tad there, but also I guess you throw in the Trump effect, which is a great unknown, isn't it? So it does make it a very difficult one to forecast if you're using history to judge the future. That said, though, Robert, if you take it further back then, and I think you can take us back to 1900 just in terms of results, what are you seeing?
Let's get this chart up. This is from Deutsche Bank, and this is the question, Andrew, that you asked that I don't think as many people are asking, which is how much impact does the president have over the stock market? Now, this is from Jim Reed of Deutsche Bank. And what this chart shows us is that 15 of the last 21 presidents have presided over annual returns between 10 and 17%. That's 71%. 3 have had single-digit returns, about 14%. And again, only 3 presidents have seen negative returns during their term. Now, the negative returns were driven that arguably mostly outside of the control of the sitting president. So you've got the Great Depression, you've got the 1973 oil crisis, and poor George W. Bush had the double whammy of the tech wreck and then the early onset of the GFC. And unfortunately, these downturns are much more painful than average. But if you look at this chart, if you look at it with all of its perspective and the wide lens, and you look at it through this wide lens, to me, it says that major events rather than policy may very well end up being the primary drivers of market performance.
All right. So beyond that, of course, and who's actually in the White House comes beyond the personality is also the policy, Robert. How is that likely to affect the market? Well, I guess there is a distinction there, certainly in terms of immigration, but we've spoken about this before too. Trade, also tax policy.
Good question. Christopher was talking about this just a moment ago as well. Again, let's bring this chart up from Jim from Deutsche Bank again. And what this particular chart is, I want to focus on one particular policy, which is tax. When we look back over the last 90 years or so, again, notwithstanding the president, notwithstanding party, what this chart is showing us is corporate tax rates in the US in green, and you've got company earnings or EPS, earnings per share, in the dark blue, and you've got a trend with a light blue going from bottom left to top right. Now, what this is telling us, I'll take this with a grain of salt, because there's so many other variables and factors that this does not take into account, is that notwithstanding the president or the party or policy to the extent that we talk about corporate tax rates, what we're seeing is a steady uptrend growth in company earnings. And so to me, what this is saying is that the stock market is more focused on company earnings rather than tax policy in its pricing. And we can see over the long run, EPS has been growing at a pretty steady rate from bottom left to top right, notwithstanding what the tax rate has been during that same time.
All right. So let's sum this all up then, Robert, and I'll ask you to pull out your crystal ball. No, not really. But what does history overall then tell you about what we can expect?
I've got some fun facts here for you, Andrew. I've got a handful of them, so I'm gonna run through these real quick with you. So just bear with me. We obviously saw October start off with a bit of a bang and then start to wither off, and we ended up the month down about 1%. Now, having said that, the stock market price-wise is still up north of 20%. So the interesting fact here is that year to date, the gain that we've seen through to October is in fact on pace now to be the strongest in the S&P 500 in any presidential election year since 1936. So you've got to go back 90 years to see the rally we've seen today in an election year. Strong rallies historically of at least 20% through October, history tells us, have been followed by stronger than normal finishes through to the end of the year, even in election years. November typically ranks as the fourth best month with an average gain of about 1.3% and positive 63% of the time. And what history again tells us is that strong momentum in the first 10 months of a year usually carries through to the end of the year, whether it's election or otherwise. Andrew, I think in the next couple of weeks, we're going to be talking about Santa Claus rallies.